There we go. Thank you all for joining us. My name is Gershom Margolis. I'm the founder of Imperial Advisory Outsourced CFOs. We provide CFO services to mid-sized businesses and help founders and CEOs make better financial decisions for their business. We have a very special panel today. For this webinar, we've got three experts in their field who are going to share some insights with us into M&A. And without further ado, first I'll say who all the three people are. We've got on my screen, we'll start from the top. We have Peter. Peter, who is an attorney who I actually met, was introduced to me, I believe, by Danny, who's on this call as well. And I've heard Peter speak. I've had the opportunity to speak with him and listen to him speak, and I'm looking forward to hearing his take on this. He's a business attorney, works on M&A and other corporate matters. There's Albert Hakim, who I've met in several places, and I've always found what he had to say very interesting. Albert works on business brokerage and also, if I understand correctly, owns some other businesses, but we won't get into that now. But Albert's a wonderful guy. I'm glad to have him here. And last but most certainly not least is Bob Doyle. Bob Doyle is our other CFO, part of Imperial Advisory Outsourced CFOs. He's been a mentor of mine, and now I have the opportunity to work with him. And so pleased to have him here as well. Alrighty, so with that, we will start. And let's start with, I guess, again, order on my screen. We'll start with Peter. Peter, please introduce yourself and tell us a little bit about how you decided to get involved in M&A. There's some people who just do corporate. How did you choose to get involved in this side of things?
Sure. So my name is Peter Papagianakis with Business Law Firm LLC. The firm focuses exclusively on business contracts and business transactions. So to answer your question, I got into it because before law school, after undergrad, I was an assistant economist for the Federal Reserve Bank. So I did a lot of economic analysis. I went on to become an assistant bank examiner, did a lot of financial accounting, auditing type work. So I was always interested on the business transactional side of the law. I was never interested in going to court or anything like that. So when I was fortunate enough when I was in law school, I did well. I interviewed with large enough law firms that have corporate departments, specialty departments that specialize in M&A and corporate. And I was fortunate enough that I got hired, and that's how I kickstarted my career and just stayed in that field since graduating in 1997.
Got it. Well, thank you. How about you, Albert? How did you decide to go into business brokerage and helping with the M&A process?
Sure, and I'll try to give you the abridged version. So my name is Albert Hakim, and I'm a certified merger and acquisition advisor. I'm with the Kensington Company. And the quick answer is that I've been a business owner for nearly 30 years. I've owned my own businesses. I've sold my own businesses. If I want to date myself, if you remember Nobody Beats the Whiz, I was the Nobody Beats the Whiz of New England. In fact, I still remember my tagline. It was New York Prices, New England Service. So fast forward many years, I was in a business transition and I needed to make a change. And I went to my good friend, Ken Stein, who is the Ken in Kensington. And I said, I got to get out of this crazy business that I'm in. What do you have for me? And I went through their process. And I have to tell you, in selling my own businesses, I was not enamored at all with the intermediaries. I found them to be a little distasteful. I never imagined I would be doing this for a living. After going through the process with Kensington Company, and I don't have the time to go into all of the detail, but suffice it to say, it was like that Remington commercial. I loved it so much, I bought the company. It was wonderful, it was enlightening, and this happened about 10 years ago. And what I'm doing now is the most noble thing I've ever done in terms of helping business owners exit, solve their problems, acquire, and using my 30 years to enable transactions to happen.
Thank you. And now, Bob, you're coming at this from a little bit of a different end. You started your career in a totally different field and got involved in this from not a transaction facilitation, but actually being a party to the transaction.
Yeah, in 1986, I joined a family-run business that was in the outsourced laundry business, and we had about 50,000 machines in the New York metropolitan area. And after a couple of years working there, and I was in the accounting department, I was the controller, and after a few years, the family decided to sell out to Wall Street, and we did an MBO, and then we ended up with a private equity firm out of Chicago, and we began to acquire other family-run businesses in the same field. And we took our New York business and turned it into a national business, and all through acquisition, and mostly family-run, not all family-run, but mostly family-run. So in the course of my 30 years there, I had the tremendous opportunity to see the business grow from 50,000 machines to 1 million machines. Revenues grew from $50,000 to over $1 billion. And we rolled up, the industry throughout the country and up into Canada. And then we went ahead and purchased the biggest air vending company. You've seen the Exact Air machines and the Air Serve machines at the 7-Elevens and places like that. That's another international company. And when I left, like I said, the company had over $1 billion in revenue. And what I really enjoy about it is, it's just a wonderful experience working with people that are selling their businesses, putting together integration programs, trying to figure out how to meld the cultures together, put the systems together, make sure this thing runs like a well-oiled machine on a national basis. And it really was exciting. So I got into this accidentally, but I absolutely loved the experience.
Bob, you and I have to speak offline about something you just mentioned.
Great. You and I were on a call once before, and after that call, I wrote your name down. I just never sent the email because I agree we should connect.
I want to tell you both that the first time I heard Albert Hakim speak or say anything was at an event hosted by Rick Marr. And I remember telling you I wanted you to meet him. I don't think I ever made the introduction, but I hope you two hit it off. I think you will. All right. So next question, we're going to pose this to Albert and then Peter. And Bob, you can jump in, but I imagine that this is not going to be for you. How has the market been since the onset of coronavirus? It's what's on everyone's mind. What's different? So interest rates are at historic lows, at least in theory. And I know that people have called me telling me, quote, I represent a group of people who have money. They want to buy businesses, end quote. And I've heard that from multiple people. So there, in theory, at least, is money that people are, burning holes in people's pockets. What are you seeing? Because whatever I see is anecdotal. What are you seeing? Are people looking for the same thing now that they were looking before, just good businesses, or people looking for something different this year?
Sure, and it's interesting that you shared what you shared. So I will tell you that everything is different. Coronavirus has affected everything, but maybe not necessarily in the way that you might think. So I think it's best illustrated maybe with a couple of stories, and I want to give you, from the good side of the ledger as well as the sad side of the ledger. But I concur that the amount of activity, the amount of buyers in the marketplace the last few months is unbelievable. It seems like coronavirus and the craziness of what's going on has gotten people to kind of push the reset button and say, okay, what do I really want in life? And maybe now is the time to go after it. So whether it's people coming out of the corporate world, whether it's businesses looking to acquire, whether it's like you mentioned, Gershon, those people who have pools of money that they want to deploy. But what's interesting here is, what are they looking for? They are looking for those better businesses. Coronavirus has decimated some sectors, but it's also shined the spotlight on some other sectors, and especially those businesses that I'm sure, Bob and Gershon, you preach this to your clients, recurring revenue, multiple streams of income. So those businesses that have some of those qualities, and let me just share this. So we have a service business where 50% of their income is contractual on a recurring basis, beautiful income. I think the contracts are 3 to 5 years. And they operate in multi-states. It's the kind of business most people are looking for, especially those that really want to deploy capital and get a great ROI. We recognize that this is going to be a very, very active situation. So we choose to market it in a very specific way, in a closed process. We get the engagement on October 10th. We prepare the book, we do our deep dive into the financials, the growth capability, and we prepare a magnificent book, and we go to market by the end of October. And our message to the market is, if you're interested, we're not pricing it, send us your indications of interest, and we'll send us your questions, we'll get your questions answered, and we're going to let the sellers decide who they want to engage with at the end of the process. The process is over on December 4th. So this is real-time stuff, listeners. I want to tell you a couple of things. First of all, even though we didn't price it, there was a target price in mind. We got 17 IOIs, indications of interest, that closed by December 4th, and the majority were way above the target price. Again, why? Because of the business. And now the sellers are in the fortunate position to engage with the parties they want to engage in to prepare LOIs. So that's, and I forgot to mention the most important thing is how we conducted meetings was all through Zoom. There hasn't been a single in-person meeting, no on-site visits, and we have all of these offers. So on the other side is, I just want to speak about the gym real quickly. So that sector, the fitness sector, has been decimated. But there's still interesting learning in coronavirus times. We sold a gym 3 years ago for $1 million to a buyer. Beautiful situation. For personal reasons, the seller had to sell pre-corona, and then corona hit. And this became ultimately an exercise in the lease. Can we find someone to relieve this seller of the burden of the lease obligation? And can we find somebody that would satisfy the landlord on the lease obligation? Long story short, we sold this business that sold it 3 years ago for $1 million. We sold it 2 weeks ago for $100,000. The seller is thrilled. The landlord is thrilled. Seller is thrilled because they can now continue on with their lives. Landlord has a good tenant. The buyer took a risk, a business gamble on a preferential lease where if you believe that things are going to come back in 6 months, a year, he's going to be very well positioned. So happy ending all around. How's my time on the answer? Can I give you one more, my favorite, or am I?
One more quick story.
Quick story. Luxury manufacturing business. Manufacture and distribute luxury goods. We marketed pre-corona. We're in contract to close in April sometime. Corona comes around. Business is off in April and May by 85%. An 85% decline in revenue. Who's touching this business? So everything gets put on hold. The seller sold to retail stores, which are hurting, but also had some e-commerce business. They continued to nurture the e-commerce, and little by little it came back. So the projections for 2020 are that the business will be off by about 20 to 30%. Last week, we got a full price offer on this business. Why? Has to do with the buyer. We found the right buyer who's in the distribution business, has warehousing, has distribution centers, can simply layer this business on top of his existing infrastructure, get rid of most of the expenses. That's the example of where 1 and 1 equals 3. Again, all interesting lessons in Corona and never a face-to-face meeting.
Interesting. I think you're already starting to touch on some of our later questions, so we'll pick up time over there.
No problem.
Peter, can you share with us some of what you've been seeing
Sure.
out there?
Sure. To quickly summarize what Albert was saying, it did come to almost like a screeching halt, let's call it, in March and April, the M&A process for various reasons. Obviously, for the economic forecast, because when you buy a business, you're buying it on based on previous results in a sense, but forecasted as to what you believe it'll be in the future. So now trying to forecast into the future by definition became extremely difficult. So sure, there's an incredible slowdown. I think what happened was, and this is falls in line with what Albert was saying, was that people then started realizing, look, at some point, this too will overcome it. And this is now an opportunity to buy certain businesses that have a lot of upside when things settle down and return to normal, and we can get them at good prices. So I think that's what happened. And if you go back to the financial crisis back in 2008 and so forth, you'll see that there's a trend with the same thing with real estate prices, for example, where prices just came to the point they were so low where buyers said, you know what, this is enticing enough for me to come back in. And now we're just seeing simply the analogy on the business side of it. So now that they're jumping in, the question becomes, okay, what are they jumping into and how is that changing the M&A deal terms and so forth? Well, as you would imagine, because they see opportunities to purchase something at relatively low prices sometimes, not necessarily all the time, like Albert said, they'll pay full price. But a lot of them, I'm seeing a lot of deals being structured based on an earnout. So what the earnout does is pays typically, there's a lot of ways you can structure it, but typically you'll pay the buyer, the seller, some portion of the purchase price at the closing, and then the balance of the purchase price gets paid over time based on certain metrics. And what that does is that takes away that question mark about the future valuation and future growth, and puts a little bit of skin in the game for the seller to say, okay, if you really believe that it's worth this much, I can give you that price or some reduced amount, but you have to meet these performance standards. And that's what we have found has been the way that has bridged the gap. And as a result, M&A activity has picked up significantly.
Quick follow-up, Peter. In terms of the earnouts, is that specifically where the owner operator stays in as an operator after the sale and he has skin in the game because he or she is responsible for that earnings and growth?
Not necessarily that type of skin in the game. That's a good distinction that you're drawing. But no, it can be where the seller owner stays on board. A lot of times it's not. Depends. It all depends on the circumstances. But what I meant by the skin in the game, meaning that it's kind of put your money where your mouth is, skin in the game, meaning that if you really do believe it's worth X millions of dollars, I'll give you X percentage of that, and then the rest I'll promise to give you in the form of an earnout. And this way you're happy at that point. But it's the way of the buyer saying, I can't risk that, base it on your word, because right now the financials and of course the uncertainty of the future can't justify me taking that level of risk. So that's what I meant by having skin in the game. It's just a way of bridging the valuation gap. That's historically how it's always been used.
Got it.
Here now.
You know, I've seen something interesting from a buyer perspective in that if you're looking to purchase a small division or a you know, a lot of times big companies have these divisions that they're just not part of their core competency and they're looking to unload them. This is an interesting time to put in bids on those businesses, because a lot of these large companies, 2020 is a great time for them to write off goodwill, for them to reduce inventories, things like that. So then when they sell the company, they don't have to take this big loss on the sale. They've taken it through some Corona thing, you know, and it helps them get past board approval and things like that. I've actually seen that twice in the last month, and it's just an interesting, you know, thing because of Corona. It's an opportunity for a buyer.
Thank you. Thank you all. All righty. So Bob, I guess I should have included you there. But all right, anyway, Bob, you get the next question first. If someone was looking to sell a business, when should they start preparing? So have you over your career seen a difference between what a business sale looks like with someone who's prepared and someone not prepared, and what have you seen?
I mean, I don't mean to be cute, but in all honesty, the day you start your business is the day you should start preparing to sell it. And the reason I say that is there's all kinds of things that go into selling the business. What does your tax structure look like? Is the business set up to turn the business over to somebody else? How do you minimize your tax impacts? Have you developed the right policies and procedures? Do you know, there's a lot of things, and you know, I think Albert could probably speak very well on this, but you know, when you're going to buy a business, you're looking for a well-organized company, somebody that someone else could step in and take over and start running fairly quick, unless you're selling or buying, unless it's a competitor. Like in the industry that I was in, a lot of times we were just buying contracts and we would just put them on our operating structure. But if you're looking to buy a running operating business, you're looking for policies and procedures. You're looking for the right people in the right positions. You're looking for a good structure when you're selling to make sure when you leave, you're going to have good tax benefits. So I would argue that the day you start your business, you should be thinking about what's going to happen to this business sometime in the future. Am I giving it to my children? Have I set it up, you know, for a succession? Am I going to sell it or am I going to liquidate it? Those types of decisions really need to be thought about day one. Because what ends up happening is a lot of people start thinking about them 10 years down the line, and you've got these things that you've been doing for the last 10 years that you now need to begin to unwind and set up the company to sell. And it's painful.
Bob, if I had my opportunity to get to a seller as little as 3 to 5 years before they have to sell, I would be thankful.
Right. That's right.
But you're absolutely right. It's the planning, it's the preparation, and it's, you know, and just to your point about the way you structure the company, you know, if you were building a house and you're trying to make a decision about, Doyle, do I put in, you know, do I put in a jacuzzi or do I not put in a jacuzzi? What increase the value? Does it not increase that? I mean, it would boil down to who's buying the house. So who the buyer is in the equation is the missing component from so much of the planning. And, you know, and that's why we like to get involved early so we can, you know, kind of drill down and then, you know, address those challenges in the business.
Yeah, and there's so many, when you buy a company, you tend to, well, when I did it, we looked at synergies, right? So what are the things we can put together and get synergies? Well, what you want to avoid are the dyssynergies, you know, the things you need to invest in that the prior owner didn't invest in, the things that they didn't take care of. And you've got to factor that into your purchase price. And it actually, so if you're selling your business, you don't want a lower offer because somebody's got to come in and make changes that you could have addressed 5 or 10 years ago. And you know what's really interesting about this? A lot of the stuff that you need to do to get the higher multiple for your business, if you do it early, you're going to get a benefit from that every year in higher earnings, cash flow. It's almost silly to wait for it. Why wait, right?
Bob, you are doing my presentation. These are my slides.
That's a great point. Not only do you get it annually as you implement it, but then you also get the big bang when you get the multiple of the at the end of the whatever metric you're using, typically EBITDA. So yeah, it's a great point.
But it's very hard. Most business owners, you know, go into business by default. They don't go in planning it like this and end up where they end up. So, but you know, if they could, this would be the way to do it.
All righty. Peter, you have anything to add on that? Or
So what happens with me, it's always, there's nothing, it's obvious what they said. It's always earlier is always better than later. You can prepare better. Not only that, the last thing I think I'd like to add, because I don't want to be duplicative, is going tangentially off of one of the, either Albert or Bob mentioned, because business owners are typically will go in and they learn as they grow their own business. A lot of them don't actually have previous experience. They actually will delay things until the very end. So just like everything else, always better to go early on, because actually that's also when you learn. You learn how to grow. That will set the foundation for you. So nothing more than what they've already added.
Yeah, and if you don't mind, Gershon, just to piggyback on Peter, because this is germane to what he does, you know, you end up, no business is perfect. No business is great. Everything has its flaws. And it's about seeing them objectively and dealing with them early. So it's not just early in the process, it's dealing with the issues that you're going to encounter so that we don't get blindsided later on in the process. And you know, that's very important.
Yeah, basically you can fix some of the glitches that you wind up noticing as you're fixing, as you're making.
And even if you can't fix it, the buyer will fix it, but address it. Address it up front,
Sure.
so that it doesn't come back and kill the deal.
Sure.
Absolutely.
Yes, agreed.
All right, that's a perfect segue into our next question, which is the title of this webinar, actually. I guess we'll start with Peter here, but in your experience, is there a telltale sign to predict if a business sale will go through? What's the mindset of a business owner who's going to be successful at selling? What is it that when you see that thing, you say, this is real trouble, or what are the most likely things to derail a sale?
Yeah, so I think there is the core, there's two components, perhaps three, but there's the core business type issues that I believe Albert and Bob could speak on. I have, to me, what's near and dear to my heart, because I've noticed it anecdotally, it's not scientific or anything like, is that what I call the soft part of the transaction. And the soft part in particular, I'm referring to the negotiations. I have found that when the negotiations are smooth and the principals are talking and they're finding, let's call it little problems or glitches, but they're able to find their own solutions, or they consult with their advisors and the advisors provide some reasonable solutions. And it's of course a little give and go. You never get 100% of what you ask for. But as long as that process is actually pleasant and amicable, I've generally found that the deal winds up going through. When there's a big disconnect between either in negotiation style or in terms of what the future of the business is, then that's where I found that a lot of times these deals don't go through. And I'll give you a very brief example. Recently, we had a seller that was younger principals of the seller that was looking to sell the business and become owners of, get a small percentage of a bigger business, sell the business to the larger business. The larger business was a couple of owners that were bigger age difference. And you could tell as the negotiations were going on some of the issues, they were going back and forth on things that I thought like, the solution's easy. Where's the issue? But for certain people, certain issues, I believe that were smaller in the larger scale of a grand scheme of things, it was much more important to them. So you knew right from the get-go when there was a disconnect as to what was important to the seller and what was important to the buyer, there was a big difference. And as a result, the deal did fall through. But to summarize my point, for me, it's the negotiations. That's when I could tell whether the deal is going to be constructive and positive, or whether it'll potentially fall through, or even after the deal, if it does go through, whether or not it's going to be successful.
So if you got involved with public companies and, you know, you could get involved with merger arbitrage and betting on which way deals are going to go by watching the negotiations.
Yeah, I guess, yes. But usually we're dealing with private companies at this point. When we were with the big law firms, it was the public companies. And of course, you can't trade on non-public information. So that, that was out the door. But yeah, the concept is there, except in the context of private companies.
Got it.
To Peter's point too, one of the things that I experienced was the more involved the buyer and seller are with each other directly seems to help. We had one transaction, we didn't lose it, but we almost lost it because I allowed the attorneys to take too active a role. The seller allowed the attorneys to take too active a role. And we ended up with like 50 deal points. And the seller and I finally got in a room and we knocked out these 50 points that only 3 of them mattered, and it was just ridiculous. We went through the list. I don't care about this. I don't care about this. I don't care about this. So I think an active involvement between the buyer and the seller is really important. Yeah,
and even though I'm an attorney, I agree. Don't let the attorneys hijack the deal, because I like to think I'm different, but a lot of attorneys tend to focus on what I like to say is the example I like to say is, look, we are attorneys. Why? Because we're risk averse. That's the fundamental aspect of being an attorney. You tend to be very risk averse. Business is about taking risk. So to be a good attorney, I believe it's very important to understand the business, work with the business owner, whether it be the buyer or seller, and really understand where are the pain points and the real risk, not the little ticky-tacky risk. And that winds up being those 3 points that Bob mentioned, for example. Now, maybe in my case, it might have been 5, but it certainly would not have been the 30 or whatever it was.
I'm so glad you said that.
Yeah, that's the key.
So anything to add, Albert?
So I'm mindful of the time, so I'm going to keep it short. What they both describing are what we term transactional. I think the seller needs to be transactional, recognize that every buyer is different, and every buyer is going to look at their business a certain way, and they've got to be mindful of addressing those concerns. If they're intransigent, you don't want my business, don't buy my, okay, then that's what's going to happen. So, you know, if you have a seller who's transactional, who's willing to address the issues that different buyers may have, that to me is a telltale sign that, you know, we're in good shape.
Just one more point on the question, Gershon. You know, I was involved in rolling up family businesses. So the thing that we looked for was what we used to call generational change, right? Often these businesses were inherited, and we're dealing with the second generation or maybe even the third generation. And you have to we had to look at the family structure and how old was the founder, or how old was the person running the company, and did they have children that wanted to get into the industry? So many times, you know, the children, because these guys had a decent amount of money, they would go out and they would become, you know, lawyers and doctors and things like that, and they didn't want to be in this particular industry. So you'd have to look at when was it time. So we would keep our eyes on that, and we would just stay in touch with the people to know, you know, where they kind of were, and they always knew we were there when they were ready. So that was how we did it. But the generational issues were what we focused on the most.
Got it. Interesting. And that may relate to some question later. Hopefully we'll have the time to get to all of them. All right. So Albert, something that you kind of started touching on, but what kind of buyer, and maybe you've already given all the answer you want to give on this, but what kind of buyer should a seller seek out? Should they, so we already know they should seek out a flexible buyer, but should they be looking for a financial, for someone who's an investor, someone strategic, looking to merge rather than operate, or operate on its own, looking for a turnaround buyer? Yeah.
So the answer is all of the above. I mean, if you're fortunate enough as a seller that you're attractive to the range, you know, the synergistic, the financial, the family offices, the private equity firms, the private buyer, if you're fortunate enough, like the business I described before, that service business, then you go after all of them. Most businesses that I encounter are not in that position. They have something about them. Maybe it's the sector, it's the niche, that they are more, or they're better suited to certain types. And look, frankly, that's why we get involved. I think, you know, other than, you know, a seller's competitors, sellers don't think about who the buyers are for their business. They don't think, you know, they're worried about making payroll. They're worried about the day-to-day. They're worried about growth. So it's our job to go in there, look at it with an objective set of eyes and say, okay, where would this resonate, or where, you know, what field would be the most fertile to plow for this particular business? So I think it's different in every case. And if you're fortunate enough that you've got the kind of business that is attractive to the whole range, you market to the whole range. And you know, to meet the objectives of the seller, whatever those might be.
Got it. Bob and Peter, do you have thoughts?
I'll take a little bit of a tangent off of that, and that is, you from the M&A advisory perspective, it makes sense to obviously be in a broad category. When you start drilling, though, into anything in particular needs, requests that a seller might have, I believe you have to start looking at some of what are those requests. So, for example, if a seller is looking to stay on board, you probably, the better bet might be a financial buyer as opposed to a strategic buyer, because a lot of times a strategic buyer will acquire and then perhaps consolidate expenses, let's call it. So they don't need as much personnel. So the flip side is sometimes you get certain sellers that they've had employees for 30 years. They're practically family. They go over each other's houses for Thanksgiving, for example. So one of the major concerns for a lot of sellers I found is, look, I've made a lot of money and I'm happy with this deal, and I can even take a little bit less, but I want this buyer to actually keep all my employees or 80% of my employees, whatever the case might be. So if you get that sort of a scenario, a strategic buyer might not qualify, as I mentioned, because of the fact that they typically are looking to actually unload employees, while as a financial buyer that perhaps it's a platform company for a private equity fund, for example, and they want to buy the business itself and realize that, hey, yeah, we want to keep the employees because we don't have a business without them. So to summarize, what I'm saying is the proper buyer and the proper seller depend on the circumstances.
Without a doubt.
Bob, do you have any?
No, I completely agree. I mean, most of what we did was tuck-in acquisitions, but there were times where we would pay more for a business because they had a particular market that we weren't experts in, and we wanted to get into that market. A lot of times you do an acquisition for risk diversification, to just find something in addition to what you do. It's close to your core competency, but that's what we do with the air business. There's times when you're attracted to certain people in the other organization. There might be certain managers out there or salespeople that have been eating your lunch, and you go out and you just buy the business, and now they're your salespeople, right? So there's a lot of reasons that people will pay up. One time we paid up for an acquisition just simply because we didn't want the competitor to get it. So you just never know.
That's game theory economics, by the way.
Interesting. All right, so we got our final two questions. I'm going to address this one to Peter and Albert, and Bob, jump in if you've got things to add on this. And then the last one, we'll hopefully have time. We'll start with Bob. All right. Do you stay involved after the merger, and what does that look like?
I'll let Albert start, and then I'll chime in. Go ahead.
So like most of the answers to a lot of these questions depends on the circumstance, depends on the business, but we very often stay involved post the transaction. So for example, a company A buys company B. Company A may want to still grow and do some more roll-ups, so we'll stay involved finding more acquisitions for company A. And also many times, this is when the good stuff happens, Gershon and Bob, for you guys, is they ask us to stay on because they know that we understand their business in a very deep way, having helped the seller, having helped the buyer. So we help them with advisors. So, we might say at that point, you need a CFO. Talk to my buddy Gershon. You need good business attorney. Talk to Peter. So that's why we like to do these things. That's why we like to get to know people. I can't wait to give Danny a referral when I have somebody who has a need in a manufacturing process, so that we have those resources to help these businesses post transaction. Peter.
So is the question in terms of whether like the advisor, someone like me, stays on board afterwards and helps, or in that?
Yeah.
Okay.
Are you involved after closing?
Yeah,
or is it?
Sure. There's the buyer perspective, of course, and the seller perspective. On the buyer perspective, we typically, after we represent them on the acquisition, as Albert correctly noted. When you go through that process, you understand the business significantly better than someone from the outside coming in. So, in an equivalent capacity, of course. So as a result, it makes sense for the buyer, for example, to continue with you, because now, even though a lot of the transition aspect of it is more business oriented, nevertheless, there might be some legal issues that will follow up. So for example, this is a simplistic one. There might be, hey, let's start looking at the contracts that the seller had, because we don't think that they were as tight as they could have been. And as they come up for renewal, for example, let's renegotiate them. Let's come up with a different template to try to work through. Or let's review our employee handbook, because the last time the seller updated it was X amount of years. And if we're going to use that same one, because of maybe we bought it as a subsidiary, for example, as opposed to just buying it as part of the assets, we'll want to update the employee handbook. So that's an example of staying on board after when you represent the buyer. When you represent the seller, there might be some cleanup matters that come up, the dissolution of the business afterwards, for example, if there's anything. But the bigger value add actually comes on actually representing the seller that sells and is looking to get into an entirely different business at that point. And that's always rewarding because, of course, there's a non-compete, so they don't get into the business that they previously sold, but they find a new business, and then you work with them actually to either acquire a business or start de novo on a new business and have it grow. And actually, coincidentally, so I currently am experiencing this. We had a business sell to, represented by DLA Piper, as a company listed on the equivalent of NASDAQ, but in London. This was way back in like 2008, 2009. The owner wound up making sort of a pivot. It was on the technology side, but wound up getting into practice management, grows the business significantly, law practice management, grows the business significantly, and now we're negotiating almost $100 million deal with a private equity fund. So it's exciting to see how he turned it around and 10 years was able to grow the business basically, whatever it wound up being.
That's a great story.
You're there all along with them because you've experienced what the back end is, and that's the best scenario because it goes back to what we were talking about earlier. Having gone through the process, they then realize, oh, you know what? There is value to paying for doing something correct from the beginning or at the early stages in order to get the big bang equivalent of preparing your business for sale to a large buyer. So coincidentally on that, the last thing, and I'll leave, is that we wound up being the second choice, let's call it, because we're a little bit larger than a private equity fund wanted to purchase. The smaller business, however, was a little bit smaller. Unfortunately, for the private equity fund, as the private equity fund did a little bit of diligence, realized that the accounting wasn't very strong, and it would take them 3 months to go back to figure out, to confirm basically the financials that the seller was giving them. So as a result, the private equity fund said, listen, we think this is a hot market. We don't have that much time. We want to find another player. And they wound up coming to my client and negotiating the LOI, and we're in process right now. So it's interesting. Things work out.
Great story.
And also going back to what we talked about, it all ties in. This is a classic example where you actually witness it firsthand.
Interesting. Thanks.
In my case, we were an acquisition story. So the professional team that we assembled tended to stay with us as we continued to grow, because when we did diligence, there were certain things that were unique to our industry that we wanted looked at more carefully than other things. And once you've got a team of professionals that know your hot points and they know your issues, it actually really streamlines the process, because there's certain things you don't care about and certain things you do. And once you get a team that you trust and they do a good job, it just makes the whole thing run smoother.
Thank you. Thank you all. All right. We got one last question, which I'll throw out to whoever, if anyone wants, any of you three want to jump in, then we'll have a few minutes for Q&A afterwards. I want to sell the business and I need the money to retire, but I'm concerned about my children who are working in the business. How do I protect them?
I'll jump in first.
Okay, go for it.
We did a lot of this. As a seller, I mean, you can get employment contracts, you can do things of that nature, which, but I would cautiously advise, once you've handed the keys over, you've handed the keys over, right? So you just have to, all I could really advise is employment contracts and bonuses and things like that. But again, once you've given up the keys, you've lost that control.
So let me chime in on that. So first of all, you can do an entire webinar on this subject, Gershon. It's such a complicated, involved, and emotional question. But recognize that we're selling this to a third party, and I think the fundamental question is, what is the value of the children? What does that asset look like to the business? How is the third party perceiving their value? So it's a seller question, and then you flip it, it's a buyer question. You could torpedo a deal that, if a buyer is in there and sees a phenomenal management team in the children, but is spooked by the fact that they don't think the children will ever be loyal to them as owners, and we need the children moving forward. So there's things you can do, and Peter, you're probably best suited to speak to the structural things, whether in terms of minority interest, employment agreements, different structures, passive income to the children to protect the children. But I think more fundamental are the communications between the patriarch, matriarch, and the children about, one, do they even want it? Two, do they want to stay? Because there are horror stories out there about kids who get stuck in a deal with a third party, and all they want to do is get out, and they're stuck for that 5-year transition or 2 years, whatever's been negotiated. So it's the communication between with these children. And if these children wanted to stay on, why are we selling to a third party? We should be doing those structures that Bob spoke about earlier on, those tax structures, and the ability to pass that asset onto the children in a way that doesn't generate a heavy tax burden. But the question that's not asked and that has to be addressed are their qualification. Are they the right people? Very often, they squander it in the second generation, and then it's blown in the third generation. So there's so many questions involved, which is why the message, and why I love doing these things, the message is get the professionals involved early. Talk about these things, figure it out, and know what you're doing in the marketplace. Because you've got to, like, if I'm going to market with that question, I better have an answer. I better address it in my book to the buyer in terms of the role of the children are going to be moving forward. And that'll color who the buyer is.
Peter.
So the question, the way to analyze this is exactly how Albert said it, and that is you have to ask all these questions in the beginning, because the answers depend on, or rather the resolution of how to structure the deal is dependent on the answers to those questions. So if you have you have so many different scenarios, they're all over the place. You have scenarios where the children actually want to stay on board. Others that they don't want to stay on board. Somewhere there's 3 children, 2 want to stay on board, only 1 wants to leave. Whatever the case might be. If you know what everyone's preference is, and then the buyer, of course, determines what sort of value added they provide, because sometimes, unfortunately, one of the children want to stay, but they're kind of dead weight, for example, and the buyer doesn't want it. So you have to figure all these things out. Once you do that, I always believe that the solutions are easy. It's not having the facts in order to create the solutions. So to give you an example, you can have a scenario where someone wants to stay on board a child, and that child is valuable to the business, but perhaps even acknowledges that, listen, they're just not qualified, for example, don't have enough experience to be the CEO. So they are welcomed, they're happy to stay on as a chief marketing person. And the buyer, let's say, says, hey, you're doing a good job. We want to come in. A lot on the private equity side, you see this a lot. You're doing a great job. Stay on board. We'll even give you, if you want, put some money in the deal, for example, 2-3% of the deal, whatever the case might be. And this way, when we resell the business in 5 to 7 years, you can actually make a nice little exit for yourself too. And in the meantime, you have some skin in the game. And we'll also we'll expand your marketing budget, for example. So the job will be more challenging and more rewarding at the same time. And so that's one way to, so they hire that child with an employment agreement. They give them some stock options, perhaps even phantom stock or stock appreciation rights. It all depends on how they want to structure it. And it works out great. And in other times you have perhaps the same exact scenario, but the person didn't really want to be there. He just did it because he thought that the patriarch or the matriarch said, they're probably going to want you. But why work on probably? Just ask the question. And
Yeah.
again,
It's hard for families to talk about these things.
Yeah, exactly.
It's a difficult conversation.
Yeah, that's why Albert said getting the advisors in early, because it's easier for an outsider to ask that difficult question and get the answer and try to get everybody to agree that, hey, this makes more sense for us to do it X as opposed to structure it as Y.
You have the son-daughter dynamic also, which is very dangerous.
They're numerous.
Daughter is more qualified, but they want the
There's
business
so many
to go to the son.
permutations of the family issues. You can't even go into that. You can't summarize all of them.
So Gershon, you need another seminar.
All right. Looks like we have our work cut out for us. All righty. So thank you. We're gonna have questions in a second, but thank you all for joining. Thanks to our excellent panel. Thanks to our excellent listeners. I have one question which somebody sent me in the chat, which I will read out loud, and then we'll open it up for a few more minutes of questions, and then I gotta hop at 11:59. So we can always do a follow-up if there's interest, and it sounds like we got a whole bunch of topics that we can do follow-ups on. All right, so the question is, with the current COVID situation, do you see a delay in M&A transactions due to the time it takes the buyer to put capital in place for the transaction?
Great question. Great question. Simple answer, yes. Banks are having a hard night. If you're doing an SBA deal right now, you're going to be delayed.
On the non kind of SBA, non-bank financing or that type of financing, but a lot of the PE funds, for example, or buyers that just have either an existing line of credit that allows them to make smaller acquisitions. There's no issue on the financing aspect of it. It's more of an issue of kicking the tires and due diligence where there's a slight delay. Now, instead of, let's say, going and visiting the facility, for example, they have to do things through Zoom and things of that nature. So there's a slight delay there. But that's specifically in circumstances where financing is not an issue. So that's an example of where there might be a slight delay from the buyer's perspective.
Great question, though.
Anyone else have any questions? Anyone want to jump in and ask? All righty.
Excuse me, if I may ask Albert a question. You presented when you started mainly from the seller's viewpoint or perspective. Do you represent both buyers? I assume all three of you represent both buyers and sellers?
The answer is yes. We do buyer acquisitions all the time, and that's obviously a whole another set of challenges. But they're especially now. We're even busier with that because as mentioned on this seminar, those who are fortunate and they have cash, they're looking to grow. This is a great time to acquire and a great time to grow.
Thank you.
Yeah, so on my end, the answer is yes, but not concurrently. So yes, we represent buyers, we represent sellers, but on different deals.
Yes.
Glad to see we have a lawyer that's not greedy.
Bob, do you want to jump in and talk about who you work with these days?
I work with you.
Awesome. So yeah, so Bob and I, we work with businesses. I mean, we've spoken to people recently. We've spoken between, I would say probably both, certainly in theory both, but practically we recently spoke with a business that was looking to sell themselves, and I think they put that on hold. But yeah, I mean, the work we do, we work with businesses often that are looking to make major investments, and acquisitions is a form of a major investment. So it's definitely something that comes up in our day-to-day, where a business, you can build something, you can buy something, you can try to figure out what the best option for you is. Sometimes it's both. But yeah, I would say we work with both sides.
Yeah, I mean, I'm personally working on the buy side with one of my other clients that I had known before Gershon and I started working together. And all the things you talked about are coming to fruition. The extended diligence period, the difficulty of doing site visits. Even when you're negotiating the LOI, you've got to put more time in it because of COVID. I think as far as Gershon and I are concerned, I mean, I think we could get involved in the diligence process. We could help in that area, right, Gershon? I mean, it could be either side of the equation, I would think.
Yeah, for sure. And to answer the question of if we'd stay on, course we'd stay on. We'd love to help them continue
That's
to
what
grow
you're
their
doing.
business. All right. We have one question that someone just sent me in the chat, which I will read quickly. I have to hop in like a minute, but as a buyer, how do you analyze the culture of the company you're buying? Of course, you can look at the numbers, P&L, but what about the impact of the people that comprise the company you're buying? How will they react?
Yeah, great question. Peter, you want to take it first or should I jump in?
Sure. So again, it depends on the circumstances. If it's an acquisition where it's the buyer is simply taking over the existing business, and let's say the classic example might be the private equity fund, for example, where they're literally just buying it and simply saying, "Hey, we're just the owners, and we're going to keep everything intact." That becomes a non-issue. The bigger, so on the average, let's call it financial buyer issue. There's always exceptions. When there's a strategic buyer, it becomes a little bit different. That's where the culture of the target becomes much more important, and those are the sort of the answers to your question become obvious after you start having the senior executives, the C-suite executives on both sides that start having conversations as to who's going to report to whom, which employees are going to be the ones that we're going to hang on, which ones we're not, why are we hanging on to them is another question, because sometimes I've seen situations where you have a great salesperson, but he or she is a prima donna, and that's bad. That winds up being a bad situation. So again, you have to know what works for the buyer, know what it is you're acquiring as the buyer, and as the seller, what you're getting into. So it's a combination of factors. I just gave you that one specific example to understand that that culture is important, but you typically find this by having conversations with top level employees at the management level.
Yeah, and I think, for me, the culture issue was almost as big as the financial issues in doing an acquisition, because you've got to look at that transition period. It is that day you finish the acquisition and all the things you did leading up to that, what you've told the people, how you've told them, your reputation in the market, their reputation in the market, is customer first, is employee first. All those issues are tremendous issues. And I think a lot of times when acquisitions are done, they're not given the appropriate attention, and it starts actually before you announce to the employees what's going on, and it carries on for years, because there's internal DNA in every organization as to how they think about their business that you have to make sure they all meld together.
So I'm going to take a little different approach on the answer because I think I understand the question a little differently. Correct? If I'm wrong, I apologize to the person who asked it. I think the question has to do with when do you have an opportunity to evaluate the culture when you have this confidentiality and you cannot go speak to the employees till much later in the process, if at all, right? Sometimes you go through a whole deal and the employees never know until after the closing. So
yeah, those are the smaller deals, though. The bigger deals.
Right, but even in some of the larger deals, right?
Yeah.
I think so it starts with the package. It starts with the financials. It starts with your conversations with the owner, and or the team that the owner has put in place. And it's in the due diligence. That's my answer. In the due diligence process, when you're going in there as a buyer and you're investigating the financials, one of the things you're investigating is the culture, and you need to be asking those questions of that management team that you're involved with, and really drilling down to gain an understanding of the culture way before you're put in front of that staff or those employees. So for me, that's a due diligence item. That's part and parcel. Just like I want to make sure that the financials are there, I want to make sure I know what I'm inheriting on the employee and on the management side.
It is. And at the end of the day, you get to the same point, which is understanding the culture. How you do it, again, depends obviously on the circumstances, the size of the deal, and so forth. But at the end of the day, it's all about understanding how people expect to be treated. Why does that work for you? Does it not work for you? Is that going to continue? Is it going to be modified? Because at the end of the day, it's all about expectations, right? That's what you're trying to either maintain, slightly modify, or totally overhaul.
So Gershon, there's 2 follow-up webinars we have to have now.
All right. Well, you and I will talk about that soon, and we got to figure this out. I gotta hop now. Thank you everyone for joining. If anyone wants to stay on and ask more questions and the speakers are interested in or able to stay on a couple minutes, you're welcome to do so. I made Bob the manager so that when I leave, it won't all end, but webinar is officially over. Enjoy yourselves.
Gershon,
Thank you all.
thank you for putting this together.
Yes, thank you.
Very much
Mr. Chairman,
appreciate it.
I wanted to compliment you for putting together excellent topic and an excellent team. All you guys were really good at it. Good job. Thank you.
Thank you.
Thank you.
Yeah.
I can stay for 10 more minutes.
Okay, well, I'm leaving. Thank you all.
Take care. Are there any other questions?
Albert and Peter, I sent a private message to Gershon that I'd like to have a one-on-one meeting with both of you. I have a lot of stuff to share, and he told me he would provide it. So just Roy Strauss, Bob, I'm sorry, I didn't see it, Bob. You, all three of you. So I look forward to meeting. I have over 30 years experience running supply chain management consulting company, and I've got a lot of stuff to share with you guys. It'll be very helpful to you.
Great.
I just put my email in the chat, so.
Great, okay. Yeah, maybe if the three of you could do that, then I could just reach out at our convenience.
Sounds
I'll
good.
put mine in also.
All right.
All right, so if there aren't any more questions from anybody on the listening in, then I'm going to take the opportunity to sign off. Bob, thank you.
Thank you.
I do have to talk to you.
Yes.
All right, so I'll make that happen. And Peter, this was a lot of fun. Thank you so much.
Pleasure. Yeah, thank you. It was great, guys. Thank you. And
Bob, don't shut it down till I get your emails, okay?
Sure.
Thank you.
all right. Take care, everyone.
Take care.
All right, take care. Thank you.
Have a great day, everyone. Be safe.
You too.
Give me 1 second. Okay. Come here and see. Hey, Danny, good seeing you. It's been too long.
You're on mute. You're muted.
He can't hear you. He's on mute.
I'm sorry,
Okay, I
Bob.
got it.
Sorry.
Bob, I'll be in touch. I got to run. Again, great job. Thanks.
Thank you. Thank you.
Bob,
Yes.
send me your information, please. I would like to talk to you. I'm a close friend of Gershon, and I would like to get to know you.
Sure. Absolutely.
You're gonna put it in chat or email it to me?
Oh, I can, well, let's see.
I can send you my information if you want in chat. Hold on. I'll put my information in chat. 1 second. Bob, here, I just put it in chat. Bob Doyle. Or if you put your email in the chat, I can email you later with some dates to meet. As a matter of fact, Gershon, I gave a webinar for Gershon. You're on mute, Bob. Bob. Bob, you're on mute.
It's weird when I pushed it, I'm pushing the space button trying to unmute me, but I'm also trying to type my email. You and I have met before.
You know, in October, I gave a webinar arranger seminar for me, a webinar, The Future of Supply Chain Software Inventory in Warehouse.
You and I met, I know where you and I met. You and I met with Ron Stair and Christine Finocchio. You went, right? Did you go to a luncheon
With
with
whom?
them at Seasons 53 or 52, whatever that place is called?
Don't
I
remember.
definitely met you someplace.
We probably met. You look familiar too.
Yes.
But if you put your information in chat, I will email you all my information.
You got that?
Your email,
Did you get it? I just sent it.
chat. One second. Oh yeah, here we are. Let me just copy it. Okay, I have it. I will email you information. Gershon and me are close friends.
Really? He's a good guy.
He's a great guy.
Yeah.
And I gave a presentation for Gershon, or he arranged a presentation for me of warehouse automation and the future of supply chain. I presented for 20 minutes and people asked questions for 30 minutes after it.
Oh, wow. That's great.
Yeah,
It's interesting.
Gershon,
When you and I met, I had a client. I still have the client. But that client was too small for what you do. But I have another client who's in the process of changing over his systems. It might be worth the conversation. So
that would be what size client it is.
he's probably 20 million.
Yeah, that's our space. Yeah.
Yeah, his is interesting. He doesn't have any finished goods. He has all parts, and as orders come in, he when I say assembles, he's not manufacturing, but everything he does is kits. You know, it's like I need one of the to satisfy your need. I need 5 of these and 3 of these and 2 of those, and they
Right.
put it together. And he doesn't have really very good systems. So
But here is the new issue, Bob, he's going to face. With today's supply chain, pieces are missing. If you try to buy a bicycle, you cannot find one
right.
because pieces are missing.
Hmm.
Last week in the New York Times, Honda in England came to a standstill because they don't have parts.
Yeah.
What happened is China closed the port with the conveyor started there. And when they opened the port, England was closed.
And we're having that problem. We're having that problem, not because of sports, but we're having that problem just because of tariffs and stuff. All the stuff that's been outsourced from China, and you know, there's a delay in the containers, and there's more.
I have a full presentation about this subject that when we speak, I will email me your schedule when you're available.
Okay.
I'm available Friday if you're available Friday.
I'm not going to be. I don't think I'm going to be available till January, to tell you the truth. I'm actually, believe it or not, I'm in a hotel right now. I'm on my way to visit my daughter in Tennessee.
Oh, good for you. Good for you. Have a great time.
And yeah, so I'm going to be. I think I'm tied up till January, but by all means, I would love to, you know, get you in front of my client and we'll talk.
I would love to talk to you, yes. And you know what I will do for you? I'm going to send you a couple of photographs in the JPEG. What do you like, landscape or sunset?
Either one.
Like water or landscape? What do you prefer?
I remember you now. You have a whole side interest. I remember.
I photograph and I published 4 books.
Either one. It's interesting when I don't do it anymore because of the iPhone is so good, but I took my camera everywhere, and I love landscape. I love sunsets. I don't like taking pictures of people, anything but people. Bridges, love bridges and fences.
I tell you what, I go to the East River. I go to the East River, the way I deal with reality. I have a 1954 Leica.
Mm-hmm.
And I take my dog to the East River and I photograph.
Yeah.
And on my website, I have a black and white gallery of the East River, dogs, bridges, barges.
Yeah.
So I will send you some black and white photographs.
Yeah.
I think you will enjoy.
I used to spend hours just looking for the way the sun would hit like a bridge, you know, where you've got the you know, where it would create the shadows. And it was just, I spent hours and hours doing stuff like that.
Bob, I can share something with you now. Put me on share, and I will show you some photographs.
Well, you have to share, right? What do I have to do?
You click on the share, and there is a plus next to it. There's a plus next to it.
I don't see it.
On the share screen, there's a plus on the right side.
Well, I can see how I can share mine, but I don't see how I can give it to you. I see reactions.
No. Are you on Zoom? Are you on Zoom?
Yeah.
If you click on the share, there